Hello all, welcome to this next economic indicator which we are discussing, which is the jobless claims data. So it's also called the unemployment, insurance benefits, or the weekly unemployment insurance claims, or the jobless claims report. So let's discuss about the utility of this data as a key economic indicator, right? So when we look at the brief history of it, right, it has been in the US since the 1967, and because of the strong reporting accuracy maintained by the US Labor Department, this has it's a very reliable measure of the broad labor market conditions, right? So kind of a strong labor market indicates a stronger economy in one sense, right? So it is again, last time we discussed the purchasing managers index, that was a monthly release. So this jobless claims data is a weekly release. So it is issued every week, um, and it is based on the actual report. So when the data is taken from different state agencies across different states of United States, so and it is collected and based on the claims which are filed by individuals, this report is compiled on a week-on-week basis. And it is a coincident indicator because it reflects the economic conditions also to some extent. And as we'll discuss, going forward, it also has a good, future value which the data can unfold. So moving forward, this is the a piece of information which I was mentioning, that it has certain predictive value for the economic activity. For example, when there is a rising trend in the jobless claims, right? When there are more individuals who are claiming for more unemployment insurance, it can give a sense that yes, the economy is trying to slow down and things like that, right? So a persistent increase in the claims of unemployment insurance, this shows that there is a dampening, consumer spirits, and there is a reduced spending, and it can lead to a reduced business environment overall. So if the claims are high, it simply shows that yes, the economy is kind of slowing down. That is the uh, that's what high claims shows. And it's also one of the component of a leading economic index, which I discussed, I think, in the earlier videos. It is used as one of the component in the leading economic index. I'll just show it quickly, that you can see here that in the all the components of among all the components of the leading economic index, you can find here that this is also mentioned here, the average weekly initial unemployment insurance claims, right? This is the jobless claims. So they have this as one of the important component of their leading economic index. And that is why, in one sense, we are also discussing this particular jobless claims data. So moving forward, yeah, so this is we discussed about the that it is a component of leading economic index. And then how do you understand this new claims, right? So for example, why can people go for an unemployment insurance benefit, right? Because job loss is something which is it, it doesn't happen only when the economy is slowing down, right? It keeps happening even during a regular functioning of economy, because job loss can happen due to company closing, because we know that companies can shut down, companies can face some risks because of the various business cycles and other things, that the companies can also face closures. It can be due to that reason also. People can The employees of those companies who have lost jobs, they can also go and file for a jobless claim, right? There can be buyouts where one company buys out the other company, and there can be outsourcing also. So overall, job loss is something which keeps on happening, and only when its intensity increases, the trend of it keeps on increasing, that is what shows the slowing down of the economy. And this is just a standard factual point, that the eligible employees they can collect benefits, and typically up to 26 weeks. Basically, this is with respect to the US, and it can change from country to country wherever the state is sponsoring unemployment insurance. And it's a good economic health indicator, because as we discussed, a rising levels of rising and sustained high levels of claims. This is very important. It should be rising, the claim should be increasing, and it should also maintain at that high level. That shows that there are some economic problems in the country. Right? While the declining claim suggests that there's some improvement. So ideally, from an economic perspective, the jobless claims should actually not be high. It can be low, can go up also to some extent because of the constant risks the companies and the certain sectors keep facing on a due to some sectoral headwinds. That is fine, but it should not keep on rising. The jobless claim should not keep on increasing, and should not sustain high. That shows that yes, there is some issue with the broader economy. So we are going for some economic meltdown. That is what this piece of information conveys. So moving forward, so to understand the jobless claims from the current perspective and its impact on the bond market and the stock market, first we need to understand the current interest rate situation we are in, right? So currently, as we know that we are at the peak of the interest rate cycle, almost we can say that we are at the peak because there are already talks about reducing the interest rate and things like that. But as of now, we know that the interest rates are very high in US. It is about 5.25, and it's very high compared to its historical standards. And when you talk about the bond prices, so bond prices and interest rates, we know that are inversely correlated. If the bond prices go up, the interest rate goes down, and since the interest rates are currently high, right, this generally means that the bond prices might be lower. So this is one factual point which one needs to know. But conceptually, the reason is that if you have an old bond, assume that you have an old bond from 2021. At that time, the interest rate was very less, right? So interest rate at the time was very less. It means you're getting a lower bond yield, right? So but now assume that a person is trying to buy a bond now, so that bond will have a higher yield. So that is what makes the old bond less attractive to investors, and that is why its price drops, right? So few people will want your old bond because it is very less, it was of a very less interest rate. So, and for investors, you can see that if you're an investor looking to buy bonds, high interest rates would mean that you can get bonds that pay you more interest. Basically, you get a more higher yield. When the interest rates are high, the bond yields will also be higher. And but if you already own something like an old bond, for example, a bond which is from 2021 or something which has a lower interest rate, so it means the value of those bond prices would already have gone down. This is what we have to understand from the bond market perspective. And from the economic context, this is very crucial that high interest rates can be seen as a sign that an economy is trying to slow down inflation, right? So this is what is currently happening. We are maintaining a high interest rate of this level to slow down the inflation problem, because inflation, when it goes out of control, it takes everything to its backseat. So inflation, higher interest rate currently is there to reduce the inflation problem. So what happens due to this is the secondary impact, but the primary reason why the interest rate is high currently is because we are fighting the inflation problem. So governments raise the rates to make borrowing more expensive, and when borrowing becomes more expensive, what happens is the people borrow less. When people borrow less, it automatically slows down the entire activity, be it from a corporate perspective or a personal um, loan perspective also. So whenever the interest rates are at the peak, the borrowing cost of borrowing increases, and the borrowing from the companies or the individuals reduces. So this is done to reduce the inflation. So this is the current situation we are actually in, right? So moving forward, and then coming to the same from the bond yield perspective, as we discussed that higher bond yields, uh, since the current interest rates are very high, whatever new bonds that are being issued currently will have a higher yield. It's a logical correlation because interest rates and yields are directly correlated, but interest rates and bond prices are inversely correlated. So just think that the current whatever bonds the government is issuing, they will have a higher yield because all the central banks have, at least at this particular point of time, all the central banks in the world are having interest rates at their near peaks. So one country is competing against the other country due to the interest rate differential basically. So because of this, the existing bonds lose attractiveness because the existing bonds were of a lower interest rate, right? So when the interest rate of the old bonds are lower, their bond yields will be lower. So that's why the existing bonds lose attractiveness. So when you read this also, the bond which were issued when the interest rates were lower, right? Think of it like 2021 or 2020, where the interest rates were lower, their yields will be less compared to the new bonds which are issued currently. So thus they become very less attractive to investors. That's why the existing bonds lose their market value. And then since we are in a higher interest rate situation, it increases the cost of borrowing, right? So higher interest rate means it's more expensive for someone like a government or a company to issue a bond because they would have to issue a bond with a higher interest rate because we are currently having a higher interest rate regime. So this might lead to issuing bonds with a higher yield, basically to attract investors. Because since the interest rate is high, you have to offer a higher yield bond to attract someone to purchase those bonds. So this is very important because this is the current situation we are in. So when the higher interest rates, currently the higher interest rates are because there's a higher inflation. This is the current situation, and inflation, it erodes the real return of bonds. So if the bond yields are not high enough to compensate for the inflation, the real returns may be negative. So that is why the bond yields also have to be high to compensate for the inflation angle, because there's no point in investing in a particular bond market if it doesn't beat the inflation, right? So ultimately the investment purpose is to beat inflation. And when you look at the market perception and risk also, investors may face higher yields, right? Investors may perceive higher yields as simply a compensating factor. They need this higher yield because they're investing in a bond. Why they're investing in a bond with a higher yield? Because they see that there is certain economic risk. What is that economic risk? One is obviously the inflation, which is currently there. It has to beat that inflation. And additionally, if there is a slowing growth also shows that yes, the economy is slowing down. It means when the economy is slowing down, the stock markets don't perform well. The equity markets, all such markets don't perform. Financial markets don't perform well, and that is what forces people to invest in the bond market. And that is why bond yields generally rise. So bond yields can go high due to an inflationary situation or a growth perspective also. So knowing the difference between these two is crucial, and that is where the data points which we discussed as the economic indicators, they help in understanding this. So this is the current situation which we are in. So I just thought that knowing the current situation helps us to understand the impact of the data. So now we'll go on to the data which we are discussing. So first is the jobless claims data and the bonds, right? So first think that there is a increase in the filings, right? So why there is a increase in filing of jobless claims? So when there is a new filings for unemployment, it means that the bond markets would react favorably. Just think of it in a simple sense that the jobless claims are increasing. So, and why is it increasing? It is increasing because there might be a sign of weakening economy. So, increasing jobless claim simply means that people are not getting jobs. That may simply mean that economy is weakening, and this is precisely why we discussed earlier that due to that heightened risk condition that the economy is not performing, people might buy the bonds. So that is why it is favorable for the bonds. So from an inflation perspective, a higher unemployment claim is associated with lower inflationary pressure. So this is what the Fed actually wants. That a key impact of its interest rate decision, hike in interest rate decision, is that it wants to see a higher unemployment claim. A higher unemployment claim means that whatever the interest rate is, the interest rates which are being held high at this particular point of time, we are seeing the impact of that through a weakening economy, right? So when the economy is weakening, the interest rate is high, so the jobless claims also should be high. So this is like a translating the impact of the higher interest rate on the jobless claims whenever it is increasing. So this is with respect to the bonds perspective, that it is good from an inflation perspective, also from a weakening economy sign also, that investing in bond market when such things happen is good. Now coming to the negative, when the jobless claims are reducing. So when when it's very opposite, when the jobless claims are reducing, what happens? It means that there is a strong economy. When people are no more claiming the unemployment insurance, it means there are enough jobs available for them, and is in turn suggests that people need not go and invest in the bond market. So they will just directly go to the stock market and invest. That is the situation. So, and an improving economy. Now, this is a catchy situation because an improving economy, it raises a concern of inflation, because inflation and growth are to some extent related, because some amount of inflation is necessary for the economy to grow. So an improving economy raises concerns about inflation, which is negative factor for bonds, right? So again, so this is why bonds in the first factor, in the first situation, when there is a rising unemployment claim, it's beneficial for the bonds, and when it is falling, it is good for the stock market in general. So this point we have discussed that uh, whenever there is a anticipation of a stronger economy and a potential inflation, usually results in lower bond prices, because this is not what the bonds are meant for. Bonds are safe haven instruments. So when this is happening, when there is a stronger economy, people generally go and directly invest in the stock market. So again, from the yield perspective, we know that bond price and bond yield are inversely related. Now moving on, this is the first thing with respect to the bond angle, right? So moving on from the stock angle, so just try to logically correlate the earlier discussion, that assume that there is an increase in the jobless claims, right? When there is an increase in jobless claims, so when there is a consistent rise in jobless claims, the stock market generally reacts negative, because think think of it, that there is an increase in jobless claims. It means that people are not finding jobs. Why people are not finding jobs? Because the companies are not able to make profits. When companies are not able to make profits, they'll not hire more people, and they'll not do expansionary activities. And when companies don't expand, their profits don't expand, the stock prices also of those companies will not expand. So stock prices may start falling. So that is where a persistent increase in the jobless claims is not good for the stock market. It shows that the economy is slowing down. So increased unemployment claims are seen as a sign of worsening labor market condition, which is a negative indicator for the overall economy, right? So again, that is why this data has strong implication from the policy perspective, whether the federal banks have to central banks have to cut the interest rate or hold them at the particular level. This data gives such insights. And now think that there is a now this is about the uh, increasing claims with respect to stock market. We know that this is negative. Now combine this with the interest rate cycle. So assume that higher jobless claim. What happens when there is a higher jobless claim? If it is due to the interest rate, then this would lead to a lower interest rate, because central banks will now try to cut the interest rate, because due to higher interest rate, the companies are not able to borrow at a nominal cost. The borrowing cost is higher. Due to borrowing cost being high, the profits of the companies might reduce, and they might not borrow also in the first place, which leads to slowing of the economic activity, right? So it's a it automatically leads to a cut in interest rate. So that is also a positive reaction, right? So in general, a lower interest rates, we know that, are beneficial for stocks, because when there is a low interest rate, there is a reduced cost of borrowing, and when there is reduced cost of borrowing, it spurs the investment cycle and business sentiments. When there's low interest rate, people also borrow, the companies also borrow, they borrow and they invest. So it shows a good economic condition. So we have to always combine the interest rate cycle, interest rate, whether it's high or low, in relation to the economy, right? So interest rate, economic condition, and inflation, all these three have to be seen together to understand the jobless claims. And whenever we talk about the jobless claims, this particular piece of information is very, very crucial, because ultimately whenever we are in a high interest rate situation or lower interest rate situation, it's the economic health which has to be seen at the first place, right? So, despite the normal positive effect of lower interest rate, the concerns about health of the labor market and broader economy take precedence. Because think that now we are in a high interest rate cycle and economic condition starts to worsen. The first thing what the central banks would do is they think of cutting the interest rate to spur the economy. Right? So that's why economic health takes precedence over the interest rate, because interest rate being high or low, the economy has to be healthy for the larger welfare. And a weakening labor market implies that there's a potential decline in the consumer spending, which can obviously negatively impact corporate profits and consequently the stock market, the share prices of those companies, right? So this is the direct correlation on the stock market. Now, last one is again, if someone is looking at the dollar from the currency pair and the forex market, for them, I think this piece of information may be beneficial. So when you think of it like there is a falling interest rate, right? Falling interest rate scenario. If the effect of the lower interest rate is there, when the interest rates fall in US, which is about to happen in a couple of months, what happens is the dollar becomes less attractive to investors. Investors will hold something, bond of some other country which offers a higher yield. Think of it like an Indian bond yield, Indian government securities which offer a higher yield than the US one. So the dollar becomes less attractive, and accordingly dollar index will go down, right? Now we have to combine this to jobless claims, because we are discussing this in the context of jobless claims. So a steady increase in the jobless claims, assume that the jobless claims are increasing. So this, what does this mean? This means that the economy is weakening. So when the economy is weakening, the central bank immediately decides to cut the interest rate to spur the economy, right? So this is the simple relation with the dollar. And of course, we have to compare the bond yields of all other countries. That's what foreign investors actually do, because they are looking after the higher returns. So when investors often seek higher returns, so they compare yields across different countries. So when they when interest rates are falling in US, dollar becomes less attractive. They shift away from US securities, right? If the US yields are lower due to falling interest rates, caused by this particular factor which we are discussing currently, the jobless claims, the foreign investors may turn away from US and they search for better returns. They may go to US equity markets, or they can go to the emerging markets like Indian stock market, Indian bond market, such things. So basically, that is where the dollar becomes less attractive for investors. And the last point is with respect to the forex market, that when there's a reduced demand for dollar, so the demand for the dollar decreases, and this in turn means that there's a weakening of the dollar. So whenever there's a currency pair like the USD INR or the Aussie USD or the GBP USD, pound USD. So when we look at the pairs, this particular data point becomes crucial, because when there's a weakening dollar, this reduces the demand for that dollar, leading to depreciation of the dollar's value. And whenever this report is released on a weekly basis, it impacts the currency pairs accordingly, right? So let me show the in the investing.com calendar, we can see that if you can search the jobless, yeah, you can see this is the data point which we are discussing currently. It is the jobless claims, right? As we are discussing, this has a 3-star rating, which means that this has a high market impact. This data point it has high market sensitivity. So that is why this is given in a 3-star, and that is why we are discussing this as a key economic indicator. And this is released on a weekly basis. We can see that this is 5th October. I think after this, and next you can see this maybe on just a minute. I'll just show the when you just look at the next week. Yeah, on the next was the 12th October, and so I think this report keeps getting released on a weekly basis. So now, since it is released on a weekly basis, how to use this? So first we have to broadly know the current trend of this piece of information. What crucial insight this can give, right? So first, So when you look at the US claims on a broader trend, like we are looking at a 5-year trend of this. So first piece of information which you can clearly decipher from this is that during the COVID, you can see that the claims increased, which shows that yes, due to lockdown and such things, the economy in general was not performing well. The claims increased, but post the unlocking of the economy, the claims started to decrease gradually, and the economy broadly, you can say that when the claims are at its lowest, it shows that the economy is very resilient. The people are no more demanding for the higher unemployment benefits, and the economy is resilient. That's what this information shows. It's the trend which we have to look for. And moving on to the lower, like for example, if you look at it from a 2-yearly view also, you clearly find out that the claims are not much high. It's pretty much stagnant, moving in a cyclical way. That's what. And now the claims are somewhere, you can say, if you consider draw a median of this, somewhere at the lowermost point, right? So what is this simply means is that the economy is very resilient. The US economy is very strong despite the high interest rate. The economy is resilient, it's very strong, and that is why we are seeing that the stock market is also strong, right? Whenever when we see the trend of this going up, like for example on a 1 yearly also, if you observe this data point, I think it was released today itself. You can see that even this latest piece of data which released today, you see that the claims are again less. So there is broadly, you can see that the claim wise, this is on a jobless claims is reducing, simply means that the economy is very, very strong. And this is a negative point from a Federal Reserve's perspective, because the Federal Reserve might hold its interest rate for a longer period of time at the highs by seeing this data point, right? So this is one crucial thing to be known. And you can see that the dollar index currently is in green. Why is it in green today after this release of the data? It's simply because when this is going down, it means that the economy is strong. When the economy is strong, it means that the problem of inflation is still not yet resolved. The inflation might take more time to come down. When inflation takes more time to come down, it simply means that the Federal Reserve will hold the interest rate higher for a much longer period of time. That is what this data point is so crucial to look for on a week-on-week basis to understand the cues and how to interpret it from the interest rate cycle perspective, and the stock market and bond market perspective. Hope this explanation was helpful in understanding the importance of this jobless claims data. Very crucial data to be tracked on a week-on-week basis, and knowing the trend of it helps to understand the overall impact on the bond market as well as in the stock market. So that's it for this economic indicator, jobless claims data. Hope it was beneficial. Thank you.